Hello friends, this is Rahul Magan here from Treasury Consulting LLP as a Chief Executive Officer, and today we are going to speak about a very interesting topic which is getting discussed in the Bloomberg and the international media, which is PIMCO is cutting the interest rate. Sorry, PIMCO is cutting the duration. As you very well understand, right now a lot of volatility which is happening in the bond prices, and 100% credit will of that will go to 4 or 5 central banks. Number one, those who decrease their interest rate to negative. Number two, Federal Reserve, whose 10-year yield is trading as 1.5, and they are willing to increase the interest rate by 50 bips in a two different tranches of 25 bips each. As per Bill Gross, who founded PIMCO, and as per an interview which PIMCO has given on the Bloomberg TV, they are willing to cut duration they are willing to cut the duration on their existing bond, which is known as total. I think it is a total return fund. I think the total AUM of that bond is approximately $64 billion. Now, today's video will help you in understanding, exactly how this works, what duration is all about, why the people are cutting this, exactly what they would achieve if they are cutting this, and so on and so forth. Before moving forward, let me tell you one thing very clearly, that nowadays you will see a lot of action in the bond portfolio, especially in the countries where carry is still present. Example, in India, wherein you are getting repo rate at 6.5%, in US where 10-year yield is approximately 1.51%, or between 1.5 to 1.6 to be precise. And last but not the least, you have in Australia, wherein you are getting 1.5% short yield, that too in dollar terms. Not to mention Indonesia and Singapore, which are growing their existence. So today's video will let you know that how to calculate the duration and so on and so forth. So exactly how it is, here we go. Duration is a measurement or a sensitivity in a bond interest rate risk. Measurement or a sensitivity of a bond interest rate risk that consider the bond maturity yield, coupon and call features. Now these call features refers to as an embedded derivatives, to be honest. These many factors are calculated into one number that measures how sensitive a bond price is to be in the interest rate changes. But one thing which you certainly need to understand very clearly, that duration is a linear measure of the sensitivity. It is not the non-linear measure of the sensitivity. So what do you mean by linear measure of the sensitivity? By linear measure of the sensitivity, I mean to say that it's only able to compute that percentage changes in 100 basis point or a parallel shift in the yield curve. So if you have a yield curve at 8.5%, it may either go 9.5% or it may either go 7.5%. So duration is the linear change in the bond prices. It is not about the non-linear change in the bond prices. So don't be in that. For a non-linear change in the bond prices, we are having something which is known as convexity. For that is something which we are going to demonstrate in the next video. Secondly, duration is generally of 3-4 types. Number one type of duration is macular duration, which is also known as weighted average duration. And second duration is known as modified duration, which is shortly known as mod duration. The formula of modified duration you can very well see here, that modified duration is nothing but macular duration divided by 1 plus YTM. YTM stands for yield till maturity divided by N. Now that N should be synced with periodicity. So that N could be quarterly, then you need to do N divided by 4. If it is monthly, then you need to do N divided by 12. If it is semi-yearly, then you need to do N divided by 2. And if it is yearly, then you have to do N. So that is a sensitivity, that is an impact of the periodicity which you need to calculate and all. Now comes modified duration. Modified duration is a formula that expresses the measurable change in the value of the security in response to the change in the interest rate. But modified duration is just like a gamma. I won't say gamma because actually gamma is convexity, but just for the sake of example, if we consider delta, if we consider macular duration as delta, then we can consider modified duration as gamma. But yes, I technically agree with the fact that It is the gamma is convexity. It is not delta, because convexity is all about change in the bond prices due to change in duration. Now here we go back to this mod duration. Modified duration is a formula that expresses the measurable change in the value of the security in response to a change in the interest rates. Modified duration follows the concept that interest rate and the bond prices moves in opposite direction. That is very sure, no doubt. This formula is used to determine the effect of 100 bips or 100 basis point or 1% change in the interest rate that will have an impact on the bond prices. We should not forget that all kind of duration, whether it is a modified duration, it is a it is an effective duration, or it is macular duration. These all are also known as linear. They are the linear. Why linear? Because they will calculate the change in the bond prices due to the parallel shift, and that parallel shift is linear. It could be 50 basis, it could be anything till 100 basis point. But when you are crossing 100 bips, and that too non-linear, here comes convexity. Then you need to use the word convexity in that regards. Formula you very well understand that how to calculate the convexity. Not to mention this again. Now we're going to show you an Excel file, and we try and teach you that how to calculate the convexity. What we did. Now this is an Excel file. I hope you are able to see the fresh logo of Treasury Consulting LLP, which we make, wherein the punchline is a simplifying Treasury world. This is the new logo which we have put in. But nonetheless, here we assume that the coupon rate of the bond is 8%, and yield to maturity is 8.5%. Number of payments is happening per year is 1, so it's an yearly, and total number of periods is 8, and the bond face value is 10,000. So with a coupon of 8% and the face value of 10,000, not to tell you that the exact coupon payment would be 800 rupees, which I am doing here pressing F2. You can very well see that this is 8% into 10 into 1 into 10,000. So this is equals to 800, right? This 8.5 is the yield which we are coming. Now that I will, for the sake of simplicity, let me increase the font maximum, right? So here we go. Since we know that this is of 8 years, so we mentioned here 1, 2, 3, 4, 5, 6, 7, 8. Okay, 8 I mentioned twice because this is for coupon payment of 800. This is for the principal payment, because at the end of the 8th period you will get your principal back. But somehow there are several people who are giving a complete 8, and they are mentioning that no, you can add coupon plus principal together. This should not be the case. What we did, we uses the yield which was given to us. Yield was given to us 8.5%. You can see the formula also. I pressed F2. I just converted this 8.5% into numbers, and I just calculated that. So I did the present value of this 800, which comes 737. Complete law. I'll show you this as well. You can see this. Wait a minute. F2. You can see that 10,000 divided by 1.85 divided by raised to the power 8. So this is a sum of the yields of the present value of the yields, which is roughly 9,700. And bimacular duration is known as weighted average duration, because first you are having an year, then you are having a coupon, and from coupon you calculated the yield, and here you will calculate the weighted average. This is, I will press F2 again. This is yield into years. This is yield into years. That is why this is known as weighted average duration. Now the total yield into years, if we add this weighted average, then I will press F2 here. You will get an amount roughly close to 60,000. And here is the present value which we earlier calculated, which is 9718. So this is the formula of macular duration. The weighted average divided by the present value of the yield. So before moving fast, let me go little slow. So first you have a yield. It could be low, it could be less, and you very well understand if the yield is less, the principal will go higher. If the yield would high, the principal would go lower. We all understand that an inverse relationship between the yield and the principal. So what we did, we put 8 coupons in sync, because every year the bond price is 10,000 rupees and 8% is the coupon that we put in the sink. 8,000, 800, 800, 800, 800. And at the end of the period, the company will pay you 10,000 rupees, which is your principal. So total, if we did the present value of all of them one by one, then we will get 9718, which you can see on the screen. And if you multiply this present value with the years, so if you are in 4th year, you will multiply it by 4 year. If you are in 5th year, you will multiply by 5th year, and so on and so forth. Then you will get this value this close to 60,000 INR. So macular duration is nothing but this total weighted average divided by this. So this turning out to be roughly 5.18 years. Now what do you mean? Sorry, my mistake. 6.18 years. Now what do you mean by this 6.18 years? What does that stands for? 6.18 years. How I can make sense from this 6.18 years? As earlier told in the video that duration is all about percentage change in the bond prices because of parallel shift. Now what do you mean by parallel shift? 100 basis point here and there. So what do you mean by parallel shift? 100 basis point here and there. So what we did, it means if then interest rate will go parallel shift, it will go to 100 basis point, because here we assume the yield of 8.5%, and in some cases whatever yield you are assuming, if the yield will shift from 100 basis here and there, then the value of the bond will swing by 6.18%. So if the interest rate will move to 7.5, okay, then it would change, then the value of the bond will change, which is 60,000 into 6.18%. If it will decrease by, if it would increase by 1%, then it would be 60,000 into 6.18%. But being it is a weighted average, so it is having little bit of complication. The complication is that it should have taken the present value of it. It should have the periodic impact of the yield as well. So for that, people are calculating something which is little more reliable than macular duration, which is known as, now press F2, which is known as modified duration. So what we are doing, which is shortly known as mod duration in Excel. Now you can go here, you can see that I am dividing this 6.18 divided by 1.0850. As earlier show also, modified duration is nothing but macular duration plus 1 plus phi tm divided by n. So again it effectively say that if the bond price will change by 1% without the weighted average, the price of the bond will swing by approximately 5.7%, close to. This is duration and modified duration. Sometimes people calculate the effective duration also, because people will say that bond price will move 1% here and there. So people calculate effective duration also. So according to them, what do you mean by an effective duration? Because some people are saying that the bond prices keep swinging, so let's calculate effective duration also. So what people do, effective duration is a duration calculated for bond having embedded option. Now what do you mean by embedded option? There are two kind of embedded option. Number one, which have call option. Number two, which have put option. Of course, you can make any structure of call option and put option. There are numerous such structures we have in the market. Now, effective duration is a duration calculated for bond that have an embedded option. The measure of the duration takes into account the fact that expected cash flows will all fluctuate as the interest rate change. Of course, it would. Effective duration can being estimated using modified duration of the bond with embedded option like a option free bond. Right? I will explain this in little technical tone. A bond with an embedded option behave like an option free bond. When exercise of the embedded option would be offered to an investor, no benefit. As such, the security cash flow cannot be expected to change over the period of the yield. For example, if the existing interest rate were 10% and a callable bond was paying a coupon of 4%. Callable bond means you have a right to buy. Sorry, company is having a right to buy. The callable bond would behave like an option free bond because it will not optional for the company to call the bonds and reissue them at a higher interest rate. So this was all about embedded derivative, which is linked with the effective duration. Now you can very well see the formula here, but we here assume that coupon rate is 8%, the maturity of the bond is 10%, sorry, maturity value is $1,000 and maturity is 8 year and interest rate average. So here we mentioned YTM, yield to maturity, assume this, because, sorry, I think there is a spelling error here, it is effective. Yes. So what we did, we assume as multiple yields from 0 to 21%. Here we calculate the bond value. This is using the PV formula. You know that the value of the bond value using calculate the PV formula. So at 0 interest rate, 0 yield, a bond with a principal of 1000 having coupon 8% and yield of 0% would be valued approximately 1640. Similarly here down the line, the best point to see here is how we will calculate the effective yield of the bond. This is how. Effective yield of the bond would be calculated it would be calculating the difference between the two valuation of the bond. So you are having a bond wherein the yield would increase by 50 bips, wherein the yield would decrease by 56 basis point, assuming divided by 2 into the yield into 0.01. This is how we will calculate effective duration. Now in this effective duration, what do you mean by this 6.53? This means that if an interest rate will first swing by 1% on the upside and then swing by 1% on the downside, the maximum shift which would happen to the bond is 6.53%. So whatever the value you would be adding, this bond would be changed by 6.53%. So this was the little introduction of macular duration, modified duration and effective duration to our viewers. Now we're back to our technical session, that why PIMCO, which is the well-known, I would say, the bond holders across the globe, especially in New York, why they wanted to sell off, why they wanted to increase the duration. Now few days ago, Bill Gross said that he was expecting that in September Fed would had a hike in interest rate by 50 bips, and he was saying that by December the Fed would hike by another 50 bips. So this year the total volume would be, a total increase would be 100 basis point. And sitting today, the Federal Reserve interest rate was, if I'm not wrong, this is approximately 50 basis point. So it will move to complete one big figure, which is 100 basis point. 100 basis point. Now PIMCO, what they did, they wanted to shorten the duration of the bond, because they are expecting that the QE policy of the Bank of Japan would work, and in this the inflation would rise, and if the inflation would rise, so would be the yield of the bond. So they don't want to enter into the bond wherein they would have a yield of, say, they would have the more duration of 5 years, they would have a more duration of 10 years. On the other hand, if the yield would change, then this would have a big impact on the valuation of the bond. We very well understand, because if you have a principal and more duration changes because of the changes in the market factor, it certainly means that 1% here and there would impact that much. So cutting down the duration is of course would help would help PIMCO. And what PIMCO is planning to do, PIMCO is planning to buy the low side bonds. Could be 1 year till 5 years, more concentration on the spot sale, which means sitting today you can do, and very less, and then a substantial part using 1 minute. So yes, substantial part is using the duration of 5 years and so. So if PIMCO would hike duration now, this would be a severe consequences for PIMCO. Seriously, what would happen if Yaled would increase interest rate in September? What would happen if not in December, then by March, Federal Reserve will increase another interest rate? Then majority of the assets which are already in the negative, they would go further negative, and it would be a big mess for the financial system, and they might lose as well. So that is what Bill Gross wanted to say. and that is why PIMCO is cutting the duration, because what PIMCO is saying that if interest rate would rise in the near future, which is by 2017, then we will participate in the rising interest rate than in the falling interest rate. So this was all about the video, but before winding, let me summarize this, that we all understand the duration. Duration is nothing but the sensitivity of the bond price with respect to change in the interest rate. Now that bond price could be with respect to change in the interest rate, but we should not forget that all the three forms of duration, which is macular duration, modified duration, and your so-called macular duration, modified duration, and effective duration, all are valuable once the shift is close to 100 basis point. If it is greater, then you have to enter into the world of convexity, and our next video will talk about how convexity would happen. And if you are having a mod duration of 6 years, which effectively means that if the yield curve will swing by 100 basis point here and there, then the maximum impact in the valuation of the bond is going to be 6%, because mod duration was 6%. This is what PIMCO is planning to do, which is they are cutting the exposure, and they wanted to invest a good amount of money in buying short duration bond. This is a good step. I also preferably feel that interest rate in the US would rise, but of course they will take some time, and of course this would have a negative impact of the carry trade as well. That is something bank need to see, because bank treasury department is doing a lot of buying and selling every day. So they also need to consider the impact of that. If all of a sudden you will join a corporate, so that way. So with this, we thank you very much, and I hope this helps you in understanding that why PIMCO is decreasing duration, because this is now more or less mandatory for PIMCO to increase the duration if they are sincerely interested in having the trade or wanted to stay in the business. With this, Treasury Consulting, thank you very much for your time, and you're always welcome to connect with us at 919899242978. We are present everywhere, which is your YouTube, LinkedIn, WhatsApp, Twitter, everywhere. You're always welcome to give us a call, and in case you have any clarification, we continue to post such videos and make you updated about what are the changes of the bond, on the market, changes of interest rate on the various rate classes, and how a variety of people are taking up, especially like PIMCO and all, and what Bill Gross is saying, and so on and so forth. With this, thank you very much, and have a nice day.